How does a massive consumer staples company, manage to sell more trash bags, more bleach, and more cat litter than ever before, hike their marketing budget to the absolute moon, and yet somehow watch their actual profit margins shrink?
Right, yeah. It defies basically all the intuition we have about scale, as investors.
Yeah, exactly.
When you move more volume, your unit economics are supposed to improve, your margins are supposed to expand. But right now, we are looking at an environment where volume is completely decoupled from profitability.
Welcome to this Talk Tickers Deep Dive. Our mission today is to cut straight through the corporate jargon of the Clorox Company, ticker symbol CLX, and their Q2 2026 earnings call.
Yep.
We're extracting the hard data, we're translating the Wall Street speak, and figuring out if this absolute staple of a stock is cleaning up or, just spinning its wheels. We are getting straight into the numbers, the underlying consumer story driving those numbers, management's really aggressive forecast for the future, and most importantly, the actionable bottom line for your portfolio. We're going to look at the mechanisms behind the math.
Yeah, and to frame what we're about to unpack for you, Clorox is navigating a profoundly K-shaped consumer environment right now.
Right.
They're dealing with shoppers who are simultaneously hoarding bulk goods and counting pennies.
Which is wild.
It is. And at the exact same time, internally, they are trying to digest a completely foundational software overhaul and ERP system transition.
Huge headache.
Oh, massive. And as if the plate wasn't full enough, they were in the middle of a major new acquisition. It's just a highly volatile mix of external pressure and internal disruption.
So let's just, strip the narrative away for a second and look at the raw report card.
Okay, let's do it.
When we dive into the top-line metrics, the core information shows that volume is actually growing slightly ahead of organic sales growth. But their price and mix, it's acting as a headwind of about 1% for the full year.
Yeah, the price mix headwind.
Right. And for the retail investor listening, let's establish exactly what a price mix headwind actually looks like in the real world.
It's important to clarify, yeah.
Because this means they are selling more physical stuff. Like the volume is definitely up, but they're either having to charge less for it or people are actively choosing to buy the lower margin versions of their portfolio. Right?
Exactly. The composition of their sales is actively dragging their overall revenue down by a full percentage point.
Right.
The physical tonnage of product leaving their distribution centers is higher. More boxes of Glad, more tubs of Fresh Step.
More literal weight on the trucks.
Yeah, but the blended realization of cash coming back into the business is lower. And when your top-line revenue composition is deteriorating like that, well, it inevitably bleeds down into the next critical metric, which is the gross margin.
Right. The money left over after you actually manufacture the product, pay the factory workers, buy the raw materials.
Exactly.
And those gross margins, they contracted in the first half of the year. They shrank.
Yeah, they did.
But, management was incredibly quick on this call to point out that this contraction was driven heavily by temporary incremental expenses related to stabilizing their supply chain and logistics.
Which brings us to the massive accounting distortion we have to navigate here. The ERP rollout.
Right, the ERP.
Enterprise Resource Planning Software. I know it sounds incredibly dry, but it is the central nervous system of any consumer packaged goods company.
Right. Explain how that works for people who aren't in corporate supply chain.
Sure. So an ERP connects the digital order from a retailer directly to the raw material purchasing department, to the factory floor scheduling, to the warehouse inventory, to the truck routing, and finally, to the billing department.
It's everything. It's the whole brain.
It really is.
Yeah.
So in Q2, Clorox reported a 1-point favorability bump in shipments. Basically a 1% revenue bump.
Okay, but the reason given was that retailers pre-built their inventory ahead of Clorox's final phase of this manufacturing ERP rollout in January.
Yes.
And I have to push back on this, or at least play devil's advocate for the listener trying to value this company.
Go for it.
They get a revenue bump because they're rolling out internal software, and retailers like Target and Walmart proactively hoard product just in case the software breaks the supply chain.
That's the claim.
But at the exact same time, Clorox's actual gross margins shrank because they were bleeding cash trying to keep that same software from breaking the supply chain.
Right.
So how much of this top-line beat is real fundamental business growth versus just a quarterly accounting illusion?
Honestly, it's almost entirely an illusion. It is a classic pull forward of demand. To understand the mechanics of why a software upgrade literally distorts the physical movement of thousands of tons of goods across the country.
Yeah.
You really have to look at the history of CPG logistics.
Right, because retailers have long memories.
Very long memories. They remember 1999 when Hershey rolled out a massive SAP software upgrade right before Halloween.
Oh, man. The worst possible timing.
Exactly. The system failed to connect orders to warehouse inventory, and they literally couldn't ship $100 million worth of candy they actually had sitting in their own buildings.
Sitting right there, but the computer didn't know it existed.
Exactly. So it's not paranoia from the retailers, it's risk management.
Right, because you don't want to explain to your shareholders why you have empty bleach shelves during cold and flu season just because your vendor had a coding error?
Yeah, it's entirely rational behavior by the buyers at Walmart and Target. So Clorox has been upgrading the system in phases. The initial phases covered order to cash and logistics. Yeah. Then they initiated a phased rollout for manufacturing, first in the summer, then in the fall, and the final, absolute most complex phase hitting all the remaining manufacturing plants in January.
It's like trying to replace the foundation of a house while the family is still inside eating dinner and watching TV, right?
That's a perfect way to visualize it.
Every time you remove a brick, the floorboards shake in the kitchen. You can't just shut down production for a month to install software.
Exactly. You're maintaining continuous operation while changing the underlying architecture.
Yeah.
So knowing this massive transition is coming in January, the retail buyers order extra inventory in December.
Making sense, yeah.
Luke Bellay, the CFO of Clorox, specifically noted on the call that they modeled for this pre-build. They expected it. But the magnitude of the retailer anxiety drove that pre-build even higher than their internal projections.
Wow.
And that is the origin of that 1-point bump in shipments in Q2.
Which means it's purely borrowing from the future.
Completely.
That 1-point bump in Q2, mathematically, has to become a direct 1-point headwind in Q3. Target isn't going to reorder Pine Sol in February if their backrooms are already overflowing from the December panic buy.
Nope, they aren't.
The shipment bump is noise. The actual unvarnished health of the business is sitting right there in the margin contraction.
But, management insists the margin pain is strictly temporary.
Right. They always do.
Right. When you transition an ERP, you incur what they call stabilization costs.
Meaning what exactly?
Basically, if the automated truck routing system goes offline for 6 hours, you have to pay expedited shipping rates to get the product to the customer on time.
Oh, that's expensive.
Very. And if the warehouse scanner system is glitching, you pay significant overtime to human workers to manually track pallets. You bring in highly paid external IT consultants to patch the code in real time.
It all adds up incredibly fast.
It does.
Okay.
And Clorox claims these highly elevated expenses will begin tapering off in Q3 and completely vanish by Q4.
Okay, but if we assume the software costs do eventually go away, the underlying rot is still there.
Yeah.
Because the software glitch is temporary, sure, but that 1% price mix headwind we talked about, that's fundamental.
Exactly.
If your customers are buying cheaper versions of your products or demanding heavy discounts, organic sales get dragged down regardless of how well your IT infrastructure works.
You're entirely right. If the software rollout is a smokescreen, you have to ask, what is the actual fire?
Right.
To understand why price mix is negative when macroeconomic inflation is supposedly cooling down, we have to look away from the corporate headquarters and look at what the everyday shopper is doing in the store aisles.
The real story behind these numbers is written in the shopping cart.
Absolutely.
So let's take that pivot. You mentioned earlier that we're operating in a K-shaped consumer environment. Break down the mechanics of what Clorox is actually observing when people walk into a grocery store right now.
Okay, so we are seeing a profound and really aggressive shift in consumer behavior, driven mostly by exhaustion. Shoppers are seeking value with a level of intensity that is, frankly, fracturing the market.
Fracturing how?
Well, a K-shaped recovery, or K-shaped economy, means that different segments of the population are experiencing entirely divergent financial realities. The market is bifurcating.
Right, splitting into two very different extreme purchasing patterns.
Exactly. On the upward arm of the K, you have consumers who are perhaps asset-rich, still employed, but frustrated by inflation.
Yeah, they still have cash, but they're annoyed.
Right. And their defense mechanism is to trade up to massive bulk sizes at club stores. So we're talking the Costco's, the Sam's Clubs, BJ's Wholesale.
Oh, yeah, buying in massive quantities.
They have the upfront capital, the liquidity, to drop $40 on a massive multi-pack of Clorox wipes. They're doing the mental math and realizing the lowest absolute cost per wipe is found in the bulk aisle.
They're acting as their own micro warehouses to insulate themselves against future price hikes.
That's a great way to put it. But on the downward arm of the K, you have consumers who are severely cash-strapped. Credit card balances are high. Wage growth hasn't kept up with their personal inflation rate.
Right.
These consumers are trading down to tiny sizes at dollar stores. They might be fully aware that buying a single small bottle of Pine Sol at Dollar General is technically more expensive on a per-ounce basis.
But the per-ounce metric is totally irrelevant to them.
Exactly. It's completely irrelevant. They only have $3 of disposable cash in their pocket to spend on cleaning supplies this week. They are managing their immediate out-of-pocket cash flow just to survive until the next paycheck.
It is a total tug of war for the company's supply chain and marketing teams. I mean, Clorox is trying to manufacture and ship pallets for the Costco shopper, buying 30 pounds of scoop-away cat litter,
Right.
while simultaneously tooling production lines for the Dollar General shopper, buying a microscopic bottle of bleach.
Logistical whiplash.
And the traditional grocery store shopper in the middle is just getting squeezed out, which explains the absolute bloodbath in the promotional environment. I mean, reading the transcript, the amount of discounting happening in certain aisles sounds desperate.
Yeah, the era of passive sales is definitively over. During the 2020 and 2021 pandemic years, nobody had to promote cleaning supplies. You put a container of sanitizing wipes on the shelf, and it evaporated.
Right, you had people fighting over them in the aisles.
Exactly. Now, competition has returned to intense pre-COVID baseline levels, and in some categories, it's actually exceeded them.
Like which ones?
Categories like trash bags, so their Glad brand and cat litter, fresh, step and scoop away, they're absorbing massive promotional spend.
Okay, let's do an ELI 5 explain. Like I'm 5 on this promotional spend.
Sure.
Because to the layman, it just looks like they're putting items on sale. But in corporate finance, this is known as revenue growth management, or RGM.
Yes, RGM.
What are the dark arts of RGM and how are they using it right now?
It really is a dark art. RGM is the science of finding the absolute maximum price a consumer will pay before they abandon your brand and adjusting your offerings to sit exactly on that razor's edge.
Oh, wow.
It's highly algorithmic, and it encompasses several tactics. First, you have straightforward trade spend, which is the money Clorox pays a retailer to feature their product in a weekly circular or put it on an end cap display.
Right, paying for shelf visibility.
Then you have targeted digital coupons, which try to offer discounts only to the specific consumers who are at risk of churning without giving a discount to the loyalist who would have paid full price anyway.
Sneaky. And then, of course, you have the packaging games, shrinkflation.
Yes, shrinkflation is a core tool of RGM. Taking 2 trash bags out of the box or reducing the plastic mill thickness by a fraction of a percent, but keeping the box price at $14.99.
So the consumer still pays the same out-of-pocket price. They don't experience the sticker shock, but Clorox's margin technically improves.
Exactly. But right now, the consumer is hyper-vigilant. They are noticing the shrinkflation.
Yeah, everybody's talking about it online.
Right, so Clorox is having to rely more on brute force discounting.
Javier Escalante from Evercore pressed them hard on this during the Q&A. He pointed out the glaring issue. In the household sector, Clorox had negative volume and negative pricing simultaneously.
Yeah, that was a tense moment on the call.
He essentially asked the CEO, Linda Rendell, are you just slashing prices on Glad bags to move volume? And the volume still isn't showing up.
And she had to answer it.
Right. She had to admit that competitors are dumping money into promotions and Clorox is being forced to match it just to maintain their footprint.
They specifically highlighted Scoop Away at Costco as a prime example of this dynamic. Clorox is running enormous promotional discounts on Scoop Away in the club channel.
Really aggressive pricing.
Because the Costco consumer is buying such massive physical quantities right now, those promotions move the needle dramatically on the spreadsheet. They are moving a staggering tonnage of physical cat litter, which artificially props up their overall volume numbers. But they're selling it at such a steep discount that it severely degrades the overall price mix ratio of the entire company.
They're basically buying their own market share. Clorox is winning the volume battle by essentially bribing the consumer with deep discounts and bulk deals, but their pricing power is getting destroyed in the process.
That's exactly what's happening.
As an investor, the logical leap here is, If everyone is so broke and inflation is so painful, why is anyone buying name brand trash bags at all?
It's a great question.
Right. Why aren't they just buying the grocery store's generic brand or the Costco Kirkland signature bags? But the data in this transcript regarding the private label threat is shocking.
Yeah, the data challenges a very entrenched economic assumption. According to management's tracking, private label products, the store-owned generics, only gained a tenth of a single share point. 0.1%.
A rounding error.
Basically, yeah.
I would have expected consumers to be fleeing to generics in droves.
You would think so, right? But when you look at the psychology of the specific categories Clorox operates in, it actually makes sense.
Yeah.
The consumer is broke, yes, but the risk of failure is too high.
The risk of the product failing.
Yeah, think about the physical consequence of a generic trash bag failing while you are pulling it out of the kitchen can. The mess, the odor, the time required to clean it up.
Oh, it's a nightmare. Nobody wants to deal with garbage juice on their floor.
Exactly. Yeah. Or think about cat litter in a small apartment. If the generic brand fails to control the odor, the ambient living environment is just ruined.
Right.
People do not want to risk a generic failing on highly consequential household tasks. They deeply want the structural security of Glad. They want the chemical odor control of Fresh Step. They just demand that Clorox discounts it to fit their constrained budget.
It's the psychology of disaster prevention. You'll buy generic cereal because the worst that happens is it tastes a little bland. But if a generic bleach ruins your white shirts, or a generic bag explodes garbage onto your shoes, the perceived cost is much higher than the $2 you saved.
That's a perfect analogy. So Clorox knows they aren't necessarily losing the customer to the generic brand, but they are actively choosing to subsidize the customer to keep them loyal.
They're using their RGM algorithms defensively.
Defensively, yes. They know from historical data that if a consumer finally capitulates, switches to a generic brand due to price exhaustion, and realizes the generic is actually good enough.
The worst case scenario for a brand.
Exactly. Winning that customer back later requires an astronomical marketing spend. It is financially more efficient to defend the turf today with a painful promotion than to try and reconquer lost territory next year.
Okay, but defending with coupons and Costco pallets is survival. It's not a long-term growth strategy. You cannot discount your way to long-term profitability, especially when your gross margins are actively bleeding from supply chain and software stabilization costs.
Right. The math doesn't work long-term.
So if they're burning cash on defensive maneuvers while waiting for an IT system to settle, how is a retail investor supposed to value this company over the next 6 months? What is the actual escape velocity here?
Well, to understand how they plan to pull out of this dive, we have to look closely at their forward guidance and the structural math they're relying on. And honestly, the baseline they are projecting for the immediate future is remarkably grim.
Define grim in this context. What are we looking at?
For the second half of the fiscal year, management expects overall category growth to sit between 0% and 1%.
Flatlining. The pie is not getting any bigger.
It is severely depressed compared to their historical norm, which generally assumes a 2 to 2.5% category growth rate.
Right.
Consumers are making more frequent trips to the store, but the physical basket sizes are shrinking. Yet, despite forecasting a stagnant market, CFO Luke Bellay is projecting aggressive margin expansion.
Wait, what?
Yeah, he told analysts to expect gross margins to flatten out in Q3, stop the bleeding, and then show solid expansion by Q4.
The math there feels contradictory. How do you forecast significant margin expansion when the overall market isn't growing, the consumer is tapped out, and you are trapped in a promotional arms race with your competitors?
It's a great question, and it requires a mechanical breakdown of their income statement. There are 3 distinct fuel sources for this expected Q4 margin expansion, and 2 of them have absolutely nothing to do with selling more bleach.
Okay, let's hear them.
First, they have general cost savings programs. I mean, every CPG company bakes in higher supply chain efficiency targets for the back half of the year.
Standard corporate belt tightening.
Right. Second, as we discussed, the complete termination of the ERP stabilization expenses. All the overtime, the IT consultants, the expedited freight, that financial bleed gets tourniqueted by Q4.
The emergency IT budget basically resets to 0, which instantly improves the bottom line.
Exactly. And third, they are capturing a highly specific 50 basis points, so a 0.5% structural benefit in the back half of the year from terminating a joint venture associated with the Glad business.
Okay, stop right there, because this is exactly the kind of Wall Street accounting magic that retail investors need translated. What was this joint venture, and how does dissolving a legal agreement magically print 50 basis points of gross margin?
Yeah, it's fascinating. We have to look at the history here. Back in the early 2000s, Procter & Gamble invented a proprietary plastic technology called Impress.
Oh, like the diamond texture stuff?
Exactly. Clorox wanted it for their Glad bags. But instead of just licensing it, P&G essentially bought a 20% stake in the Glad business.
Wow, I had no idea they were partners on that.
Yeah, for 2 decades, Clorox has been operating Glad as a joint venture, which means they were structurally sharing a portion of the profits or paying specific fees back to P&G for that technology and partnership.
Okay, so a chunk of the money was always walking out the door.
Exactly. By terminating that agreement or buying out those specific operational obligations, Clorox no longer has to siphon off that slice of the Glad revenue. The gross margin improves mechanically by 0.5% simply because the revenue stays in-house.
So the margin expansion isn't a miracle of consumer demand. It's a combination of the IT guys finally going home and the accountants restructuring a 20-year-old contract?
That provides the baseline lift, yes.
But to actually grow the underlying business, you still need people to walk into a store and choose your product over the competitor's coupon. Which brings us to what I consider the most dramatic, high-risk element of their entire strategy.
The innovation blitz.
Yes! Management is heavily pivoting away from defending with price and launching an outright offensive with product innovation.
They're literally doubling their historical average investment in product launches for the back half of the year. It really is an innovation blitz. They are betting that the only way to permanently break a promotional cycle is to offer something so clearly superior that the consumer stops looking at the price tag.
Double the marketing budget for new product launches. Let's dig into the actual science and psychology of these products, because if you, as an investor, don't fundamentally believe these new items will sell, the entire bullish thesis for the second half of the year collapses.
Right. The flagship rollout is a brand new platform within their core cleaning business called Pure Allergen.
They spent a lot of time on the call differentiating this. This isn't just, a surface cleaner that traps dust in a wet wipe.
No, Linda Rendell described the mechanism of action. It is a proprietary chemical technology that actively denatures and destroys allergens on contact upon a surface.
Destroying the proteins.
Yes. They aren't targeting the general cleaner market. They're targeting a highly specific, highly motivated demographic, the severe allergy sufferer.
Right.
Think about the economics of someone with a child who has severe pet dander or dust mite allergies. They're already spending a fortune on HEPA air purifiers, specialized vacuums, and daily antihistamine medications.
The psychology there is fascinating. That consumer is completely price inelastic. If you tell a parent that a specific spray will actually destroy the protein that causes their child's asthma attack, they are not going to stand in the aisle and calculate the price per ounce compared to a generic bottle of Windex.
No, they won't.
They're just going to buy it.
That is the absolute essence of regaining pricing power.
Yeah.
You identify a point of friction so acute that the price premium becomes a secondary consideration. You move the product from a commodity to a health solution.
Okay, so that's Pure Allergen. What else are they launching?
The second major innovation is a defensive upgrade in that hyper-competitive trash bag category. They are launching an expansion of the Glad Force Flex line, integrating a new technology called LeakGuard.
When I read the transcript on this, it felt almost comical, but it is undeniably brilliant because it is universally relatable.
Oh, absolutely.
The absolute worst, most visceral household chore experience is pulling a full, heavy trash bag out of the kitchen cylinder and having a puddle of unidentified, foul-smelling liquid leak out of a micro tear in the bottom right onto your floor.
It is a universal failure point. We've all been there.
It's the worst.
So Clorox has engineered a specifically absorbent layer into the bottom of these premium trash bags. The mechanism literally absorbs the ambient liquid from coffee grounds or food waste and traps it, preventing the leak entirely.
It's like a diaper for your trash can.
Basically, yes. And again, look at the behavioral economics here. A consumer might be scouring the weekly circulars to save 50 cents on eggs, but they will gladly pay a $2 premium on a box of trash bags to insure themselves against the disgusting, time-consuming kitchen cleanup.
You're selling insurance against household disasters. I love that. So we have the protein-destroying allergy spray, the diaper bottom absorbent trash bags. What else is in this massive innovation budget?
Well, they're executing a complete multi-year ground-up relaunch of the entire cat litter portfolio.
Huge undertaking.
Yeah, new packaging architectures, modernized graphics, updated clumping formulas. They're trying to claw back the market share they bled out to competitors in the club channels.
Makes sense.
And then, completely shifting gears, they highlighted a new food product rollout, a non-seed oil Hidden Valley avocado ranch dressing.
That is a wildly specific product, a non-seed oil avocado ranch.
Very specific.
That is targeting a very loud, very internet-savvy, health-conscious demographic that obsesses over the inflammatory properties of canola and soybean oil.
Right. It demonstrates that their RGM and marketing teams are acutely aware of emerging, highly vocal dietary trends. By formulating a product that removes the objectionable ingredients and substitutes a premium fat like avocado oil, they can capture that niche consumer who is willing to pay a massive premium for a salad dressing that aligns with their dietary philosophy.
So they're throwing double the normal marketing budget at fancy leak-proof trash bags, allergy-destroying sprays, and trendy internet ranch dressing. But here is the curveball that makes this entire earnings call so complex.
Oh, here we go.
In the exact same breath, while discussing flatlining categories and a massive software transition, they confirm they are acquiring Gojo Industries, the privately held makers of Purell hand sanitizer.
Yeah, that was a huge announcement.
They're buying one of the most recognizable hygiene brands on the planet, right in the middle of all this internal chaos. Is this a brilliant synergistic play to dominate household and professional health, or are they getting distracted and risking a massive operational failure?
The integration risk is immense, and Wall Street knows it. Robert Moskow, an analyst on the call, immediately flagged this.
What did he say?
He pressed management, essentially asking, you are currently juggling multiple weak, highly promotional categories. You are still stabilizing an ERP. What is the operational risk of getting distracted by integrating a massive, completely separate supply chain and brand like Purell?
Right. Let's unpack the Purell asset for a second. Gojo Industries has been family-owned for decades. Hand sanitizer had the most extreme boom and bust cycle of any product in modern history.
Oh, the whiplash was insane.
In 2020, you could sell a drum of it for its weight in gold. By 2022, companies were literally paying hazardous waste facilities to incinerate excess inventory because the market was so saturated. What is Linda Rendell's defense for buying this asset now?
Her defense heavily relies on Clorox's existing footprint. People forget that Clorox has a massive, highly profitable, and very quiet professional segment.
It's a B2B side.
Exactly. They sell industrial-grade cleaning supplies to hospitals, schools, and commercial office buildings. Purell plugs directly into that existing B2B sales machinery. The sales rep, who is already selling Clorox hospital wipes to a procurement officer, can now add Purell dispensers to the exact same contract.
Okay, the synergy there is obvious. But the distraction risk is the real issue. How do they prevent the team trying to fix the leaky trash bag margins from getting pulled into the Purell integration?
Rendell insisted that the organizational structure is strictly firewalled.
Firewalled how?
They are standing up a dedicated, isolated Purell integration team. The executives and supply chain managers responsible for turning around the Glad business or launching the new litter portfolio will have absolutely zero crossover with the Gojo acquisition. They are attempting to completely isolate the risk.
The classic, we can walk and chew gum at the same time, corporate defense.
Pretty much.
But synthesizing all this strategic movement, the underlying philosophy is clear. Clorox management fundamentally believes that true product superiority is the absolute only way to escape the coupon trench. You cannot digitally optimize your way to long-term dominance. You have to physically invent something better, charge an unapologetic premium for it, and market it aggressively.
Exactly.
And structurally, because the final 8 cents per share of those digital ERP adjustment costs will completely bleed off the balance sheet in Q3, the financial runway is technically cleared for these new innovations to actually impact the bottom line by Q4.
Right. So for the person holding the ticker or staring at the buy button on their brokerage app, how do we price in all this chaos?
That's the million-dollar question.
We have a company dealing with a hangover from a massive software rollout, fighting a brutal coupon war in the aisles, restructuring 20-year-old joint ventures, buying a hand sanitizer empire, and aggressively betting the house on premium innovation in the back half of the year.
This requires a clear, actionable synthesis for you guys listening. based on the depth of this transcript and the mechanics we've uncovered, we are taking an opinionated stance. We are definitively, cautiously bearish for the immediate next quarter Q3.
Yeah.
But we're overwhelmingly bullish for the long game, specifically looking ahead to the mathematical setup for fiscal 2027.
The split verdict is essential here because the short term is going to be incredibly, painfully noisy.
Very noisy.
Q3 is a trap for the uninformed investor who just looks at trailing indicators. Think about the gravity of what Q3 has to absorb mechanically.
Let's lay it out.
First, it has to absorb the total reversal of Q2's inventory pre-build, that 1% artificial revenue bump we talk about, the extra bleach Target bought in December.
Right.
That becomes a literal revenue vacuum in Q3. Target is burning through their backroom stock instead of placing new orders.
Yeah.
Q3 volume is going to look artificially terrible.
It will look like consumer demand fell off a cliff, but it's really just an inventory unwind.
Exactly. Second, Q3 has to absorb the absolute last of the ERP stabilization costs, the final invoices from the IT consultants, the last of the expedited freight bills. It is the final financial cleanup of the software mess.
The last of the bleeding.
Right. And third, they're launching double the normal innovation marketing budget into a consumer environment that is still financially tapped out and demanding heavy discounts. You have depressed revenue, final IT cleanup costs, and a massive marketing spend all colliding in a single quarter. Q3 margins are going to be flat, and the headline numbers will likely look weak.
So, actionable takeaway number one. For the retail investor currently holding CLX, brace yourself. Do not panic sell if the Q3 headlines look ugly. It is a structural inevitability. And if you are sitting on cash considering initiating a position, do not buy in today expecting a Q3 earnings pop. The near-term physics are just too messy.
But if you look past the noise of the next 3 months and you analyze the underlying normalized math for fiscal 2027, the picture changes dramatically. It becomes one of the most compelling setups in the consumer staples sector.
Let's do the 2027 math, because I think this is the hidden gem buried deep in the Q&A section of this call.
Yeah, an analyst named Chris Carey dug into this exact issue. Because of how the ERP transition forced the company to shift sales backward into previous fiscal quarters to accommodate the software downtime, the current fiscal year 2026 baseline is artificially understated.
Right, it's pushed down.
When you just roll the calendar forward to next year, when there are no more software transition timing quirks, no more pre-builds, no more inventory vacuums, Clorox gets an automatic, baked-in 3.5% sales bump.
Just by the calendar returning to standard operating procedure, they literally don't have to win a single new customer to get a 3.5% lift on paper.
Exactly. And more importantly, that normalization provides an automatic 19-cent earnings per share boost next year.
That is a massive mechanical tailwind, a 19-cent EPS boost that requires them to do absolutely nothing other than exist in a normal timeline without touching their core server architecture.
Now, layer the strategic bets on top of that mechanical tailwind. If you, as an investor, believe that their new pure allergen cleaners and their leak-proof Glad bags actually work and can justify premium prices by Q4, well, not ... but you know.
Yeah, if they actually sell.
If you believe that the Purell acquisition will seamlessly plug into their B2B hospital sales network, then the setup for 2027 is incredibly strong. You have a suppressed valuation today, masking a mathematically guaranteed margin expansion tomorrow.
Actionable takeaway number two. It is a solid long-term hold or a strategic accumulation play on red days, provided you have the stomach to ride out the Q3 noise. You're essentially buying a baseline structural improvement wrapped in short-term software confusion.
We started this deep dive talking about the paradox of volume and margin and the expectation of precision in financial reports. The headline numbers for Clorox were a mirage, heavily distorted by an IT project.
The real operational story is a K-shaped consumer forcing a brutal coupon war. And management's escape plan is betting the house on premium problem-solving innovation.
It is a classic corporate transition story, but it leaves us with a final thread to pull, a broader psychological question for you, the listener, to mull over as you evaluate not just Clorox, but really any consumer staple in your portfolio.
What's the thread?
Clorox is making a massive contrarian bet on human nature. They are betting heavily that even in a strained economy, even when the consumer's credit cards are maxed out, people will still willingly stretch their budgets for a premium branded product if it solves a distinct, highly frustrating, visceral household problem.
It challenges the most basic economic assumption, right? That in tough times, everyone automatically capitulates and trades down to the cheapest generic option available.
It does. So the ultimate question you have to answer is, will product innovation defy economic gravity? Can an absorbent layer in a trash bag force a cash-strapped consumer to open their wallet just a little bit wider at the checkout lane?
If the answer is yes, Clorox has found the blueprint to clean up the market.
And if the answer is no, they're going to be stuck fighting in that promotional coupon trench for a very long time.
Will innovation defy economic gravity? The market will decide in Q4. Thank you for joining us on the Stock Tickers Deep Dive. Keep your portfolio sharp, keep your analysis sharper, and we will catch you next time as we look behind the numbers.